Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each week we cover off different industries using weekly charts on a long-term time frame to try and help investors stay positioned in the market to profit from the market's moves. We've got a lot to cover this week, so I want to speed it up a little bit. I'm going to go through my Market Buzz or my client chart list called Recession Data, and it's arriving, and so I think it's pretty important to share that with you. I do want to add a couple of other notes because I think we're at a particularly critical place in the market, and I want to make sure that people are prepared. So the agenda, we're going to walk through my recession chart list, but I really want you to think about, if you're not prepared for what is next, either up or down, just even think about trying the $7 subscription for 1 month at Osprey Strategic right away, because we're getting into a zone here where if the market can turn, it would be nice to get back on board. But more likely, it looks to me like we're going to go lower, and we still need a method of getting back into the market if we move to cash. And that's one of the things that we try to focus on Osprey Strategic, is getting you out of the market with your capital and back into the market near the lows to help you make some big money in the market. So again, just some things we offer at Osprey Strategic. You can try the membership service. An annual membership is only $860, which is less than, $15, $16 a week. It's not that much. And then try 1 month at just $7, and all of that can be found on the homepage at ospreystrategic.org. What you'll get is award-winning technical analysis. We do a weekly newsletter and weekly video that are highly rated by my clients. They do enjoy it. So I just want to point it out that it's there. It does help people, and I'll give you a couple of examples that I received in the mail just this week. I just want to say that I really appreciate how thorough and timely your updates are. At first, I thought your service was rather expensive, and I'll admit that I was somewhat skeptical that I'd find enough value in it, but after reading and listening to your daily and weekly updates over the past month, I was compelled to sign up for the annual subscription. It must be a tremendous amount of work to put out so much content each week, but I, for one, am very grateful for your commitment and diligence. Because of you, I raised more cash than I ever have over the past 10 days, and with the tools you offer, I feel confident that I will put it back to work at a more opportune time. Another client from Friday, in a short time, I've been a subscriber of you. I'll just say that I'm amazed at your insight and anticipation of the market. I'm very appreciative of your weekly videos and your explanations of what you see in anticipation on a short time frame. I've been watching the videos a few times during the week and get more out of them each time I watch them. Your weekly newsletter is nothing short of amazing. Your format is perfect for providing the short-term insight and how it fits into the longer view of the market. So those are 2 emails I received just this week. But what I want to try and point out is that the goal here is to try and protect capital as much as possible and then put it back to work when the wind starts sailing with us. And until then, it's really important to just try and not lose capital. So that's the big commitment right now, and I want to make sure that people are aware of it. So I don't usually go into this much of a sales pitch, but I think it's quite an important period of time for you to think about, if the market does make another big leg lower, are you prepared? And then if you are prepared, great. And then how to get back in, and hopefully you've got a method to do that. Okay, so I want to cover off the CPI data because it came out on Friday, rattled the markets, and then on Monday we moved lower. I'm recording this before market opens on Tuesday, so we'll continue to watch to see what happens. But the point I want to make is this goes back to 1966 on this chart. And you see these periods where the market had a rough time in these black boxes. And a lot of times it was hit by spikes in inflation data. So as we watch this market deal with this, and you can see that this spikiness is some of the biggest spikes we've seen. The one in 05-06 didn't really show up, and then obviously 07-08 kind of caught up to us and dealt us a pretty painful hand. But the main issue that we've got here is most people aren't correlating a chart to the actual market and what happens. So they're sitting here saying, oh, I'll wait for the recession to arrive to get out of the market. Well, when the recession's actually here, the stock market will be looking for the exit of the recession, and we'll start moving up as the recession is mid-cycle. So you're sitting in the middle of a recession, things look dire, but that's when the stock market starts improving. We have exactly the opposite situation here in May and April and March. We had, investment houses saying, yeah, we see a recession coming a year from now, could be a year from now, as we see the bond yields invert. What that doesn't tell you is when the stock market's going to start to price that in. It just tells you when the economy is going to go into that part of the market. So we need to be much more tactical in our approach. We need to move into the market while it's dire looking out there, but the charts will change and we'll change with them. And in this case, the charts are telling us that we're actually in the second phase of the bear market, and that's why I think it's so important that we understand that we might have a bigger issue on our hands. So some of these big bear markets that we endured were in the 99 to 2000 period, where we saw the S&P take a while to roll over, just like it did this time. Took a while to roll over, and now all of a sudden we're feeling the effects of it. And if you go look back in the 07, 08, obviously there was a big home building issue going on during that period of time, where we had a lot of speculation in the home market. I don't know if that sounds familiar to anybody, but that was a pretty big deal. And we also go back and we can look back in 1972 to 1975. We had a lot of inflation in there, and look what the stock market did in that period. In 68 to 70, we had some inflationary spikes, and they were let's just call it moderate, but probably what was more important to recognize is it never went down into the lower half of the chart, and we still had some market pressure. Through the late 70s, the market went sideways to down. Well, we had a lot of inflationary pressure, and then obviously we had the Volcker move in 80 to try and change the bond market and deal with inflation. And so he brought inflation, the rate of inflation started to slow and come down. Obviously, the market pulled down into the low in 82. And then once inflation, I'll call it, was looking like it was under control, which is probably a better way to say what happened there, we went on a massive bull run. So this timing was pretty big, right? It was 18 years long. Well, we've been on a federally induced buying program where the Fed stepped in to help us all the way along. And now they have to deal with the other side of the problem, which is the inflation. And so we don't know how big the wave down is going to be. We just know that we're in one. And what I want to try and point out today is my recession indicators are telling me that those are starting to show. So here's an example. This is the price earnings ratio for the market, and I've shown this chart a few times on the Market Buzz, but here we are at the 10 times earnings, 15 times earnings, 20 times earnings, and we were literally up here around a 30 times earnings. And so during the COVID crisis, if that's what we want to call it, or the COVID dip, where the Fed came back into the market and kind of put forth some capital and it buoyed everything up. That was fine. But the problem is we literally got well over our skis here and ran ahead of the market. And now we're just coming inside the high level of that. And again, if we don't have Fed support, do we trade back down to 15 times earnings, or do we trade back down to 10 times earnings? Those are very good questions to ask. I will just say we still have a lot of room to move down. If we got down to a 15 times earnings, which is typically the middle of the band, and you can see since the 90s, we've traded well above that level. So maybe that's too bearish to get down to there. But that would be at 2967. So just a little under the 3000 level, making that pretty hard. So we're currently at 3749. That would be, another 700 or 800 points below here. Okay, so let's go look at housing starts. And I think this is the 06 crisis that we saw. And what happened in 06 is the housing markets, single family home construction, PPO momentum went below zero. And when it did that, that was a pretty good clue. And you can also see that we had some periods back in 80 to 82. That might remind you of some stuff we just saw on the other chart, some 73 to 75 period in there. And then obviously in the late 80s, we spent a period where the house prices didn't, where we had some problems in home building and the momentum was pretty negative. Well, we've just ticked negative here. And so we bounced off zero and have now rolled over into negative. So to me, it's telling me, yes, we are going into another period where these high interest rates are going to slow momentum in the housing market. And that's a pretty important thing to remember. So that's a big one. Now, I will say for housing starts, which is not single family, it's just everything, this chart is still trending higher and shows no sign of problems at all. So just taking, single family versus townhouse or multi-unit developments is all we know is that this chart still appears fine. And we don't see it. But on the actual single family housing stats, to me, it looks broken. One of the charts holding up extremely well is this industrial production chart, and it looks so strong. And what I can't figure out is I've seen some other industrial production charts floating around on the web that have totally different data. They show things kind of migrating lower for a long period of time here. So either this chart is wrong or somebody else's chart is wrong, but we're sitting here with a difficulty in terms of time frame. And this was as of the end of April. Now we should, in the near term here in the next couple of weeks, get something for May. But again, what we're watching for is, does this start to roll over? And that would be another clue that things are going to click lower. But this is one of the charts I'm more concerned with. This is the 10-year trend or the 12-year trend on banking. And if we remove the COVID low, which I want to call a medical issue rather than a stock market issue or an economic issue, when we see this big long trend line, and again, it's got 7 or 8 touch points, it was a pretty important trend, and we're clearly breaking this. And not only are we breaking it, but we're falling under the 40-week moving average. We bounced and we failed at this level. The PPO momentum indicators going below zero, typically that's not a very good place. Now again, we used to have the Fed who would come in and help us make market lows. We don't really have that opportunity right now, and so this is a pretty critical chart for me. And again, all of these lows were created with the help of the Fed, where they basically stepped in and did something that changed the market response. And as that happened, then money would flow back into the market, either in the form of the Fed kind of adding capital into the market or liquidity. And then that would help large institutions who could start to invest, who would start to turn things back up. We don't have that right now. We have quantitative tightening and we have interest rates rising. So that's the banking. One of the other areas of the market is transportation, and that's a pretty big one. So if I just go to the transportation, you can see the airlines, and I took out the 2009 low and the COVID low, but in general, there's kind of a best fit line under all of this data. I'd say 1, 2, 3 touches here, 4, 5, 6, now 7 touches. So the line appears relevant to me, but the problem is it's rolling over well below zero. That is not really a good thing. For me, that's one of the biggest indicators I have that the market is going to break meaningfully lower. And we saw this in 08 where it rallied up and then failed well under zero, kind of in late 2007, and in 2008 where it rolled over. So I'm really worried about the transportation sector, and it could be that people won't have money to travel. I don't know. It's also the price of fuel. So there's lots of things going on there that make this a little bit of a dangerous chart. But to me, it tells me that there's bigger problems out there. When we go to the automobiles, this isn't part of the transportation sector, but I think it's equally important because if you've been to a car dealership at all lately, they're trying to sell cars and they don't have any, so you have to order one every time. That's really rare for the US population. Now, when this chart went negative back in 08, it was a concern. In 2004 to 2007, it didn't really do much in there. But what you can see here is this chart has just gone negative. It's down at minus 10 or minus 7.5. But that's one of the worst levels on the chart, and we're just getting started in the rollover. So to me, if the economy is really going to suffer, this is a pretty big deal. And again, from a relative strength perspective compared to the S&P 500, we're really starting to see it make lower lows and lower highs. That's typically bear market material. So looking at railroads, what we see on the railroad chart is we had a big uptrend, and I can add a little bit more data here. What you can see, let's just use this top line for now. That bottom line doesn't look very valuable. But you can see this big trend here for 6 years since 2017 was a pretty big one. If we put it off the 2016 low, either way, it's still broken. And again, I removed COVID from most of my stuff because it doesn't really help us. But here we are with the rails kind of breaking down, making new 18-month lows, and our PPO going below zero. Again, it went below zero for COVID, and it went below zero in the 2015-16 timeframe where we had kind of a bust in commodities. You might remember oil prices dropped in there, and we had quite a interesting economic situation. We made the bottoms when crude kind of bottomed out around $25 in 2016. Now we look at trucking, and on trucking, this one does a good job of really talking about the S&P 500. And the reason I say that is whenever the PPO went below zero on the trucking index for any meaningful length of time, we were in some sort of a correction that the Fed helped out with. So late in 07, then in 08, we rallied back up, and then we fell apart into 09. And then in late 2011, we had an issue. In 2015 to 2016, the same issue we saw in trucking, we saw in railroads, we saw in trucking. And then in 2018, which was the end of the tariff tantrum with China, and then we had the 2020 COVID lows. And now here we are pushing down to a level that we saw in 2018. And that was kind of the lowest level going all the way back to the 08-09 period. So something in the trucking is specifically damaging, and obviously their freight costs are one of them. But everything on this chart just says we need to be more concerned and more aware than we have been, that something bigger is unfolding. When I look at the world index, it's still holding above its trend line, which I particularly like. I think that's a very comforting signal, but we have some room to get down here. We're sitting at around, let's say, 450, 455, and we could get down to this 425, and it would kind of touch this line. So we have another 6 or 7% down we could go. And then we'd be right on this line, marking a long-term uptrend. Now, again, the bankers have already broken that line, so that's a bit more concerning for me, making me worry a little bit. Now, this one comes off the 03 low, whereas the bankers I had coming off the 09 low, just to make a difference. I also have broker-dealers, so I'll just jump down there and show you that one. Broker-dealers tend to be a leading indicator, and if we open up this chart a little bit more, what you can see here is this uptrend. And again, we could get kind of close on the 2009 lows, but we'd be down about here. Anyway, you could see the 2012, 16, 2019, and now we're sitting right on this trend line. So the real question is, does this hold? And the problem is I actually think it breaks. Now there's support down here at 300. We're currently at 370, so that would be like real rough, another 20% down. 10% would be 37 points, 20% would be 74 points. So if we move down to, I'll call it horizontal support, and that would be the 2018 and 2020 highs, that also takes us back, not quite to the 07 highs, but just to give you an idea of some real meaningful damage that would happen in the broker-dealer. So it's really important that we hold this trend right here. And if this market is going to start making new lows, we need to be more worried than I think most people are about an actual bigger bear market. And again, this is a long trend line, 10 years. Again, removing the COVID low as part of the trend line. It helps when your trend line touches more often. It makes the line more important. If we zoom in, we're breaking the line. This is as of, again, Monday, June 13th. We're breaking the trend line. But we also see down here that our PPO is in a situation where it's pretty weak. Some would say this is at the point where it always turns around. That's true, but all of these other lows were made by the Fed. So that's what gives me more concern. Whereas we're back in this 07-08 timeframe, it might slide for a while before we actually get help from the Fed as they try to control inflation. So these are pretty meaningful charts, in my opinion, that are showing structural damage. Now, if we go to the yield spread on the bonds, actually I want to go to this one. If we look specifically at the numbers here, and what you see is 342 is for the 30-year is below the 10-year, the 5-year, the 3-year, and almost the 2-year. So what that tells us, a lot of the yield curve is inverted, where the short-term yields are higher than the long-term yields. So in April, when we had our first inversion, most of the people were talking about, well, we have a year because of the recession before a recession actually hits. Well, I think the bigger problem is when will the stock market price in the problem? And what we're seeing is it's pricing it in now, and we're starting to see this as a problem. This situation is still rising, and if we just look through some of the other bond charts, this is the 30 versus 10, and I've got the difference between the two, and we're sitting right down here at zero. So the 10-year inverting to the 30-year doesn't give us a lot of comfort. That happened in 2006 where we had a problem, and in 2000 it actually went below this line. So we're in pretty rare company here to get down to these really negative levels. I think it's important that we understand exactly where we are. A lot of these things are lining up with the big recessionary periods we've had over the last 25 or 30 years. And most people continue to believe it's just business as normal. So I think it's a compelling time to be aware. Now, we also have some other things like personal consumption. This chart still looks healthy. Everybody's still buying, and our PPO momentum indicator reached a very, very high level. We could use a rate of change indicator on here or whatever, but I'm just saying the chart still looks strong. We see no real structural damage there yet. When we look at the unemployment claims, I've inverted this chart, and the idea behind that is so that it would match the stock market. So when this chart's rolling over, so is the stock market. And what you see is from a very high level, we're rolling over, and the stock market has started to roll over, and our PPO momentum indicator has started to roll over. It's still well above zero. What we don't want to see, obviously, is a big dip below zero like the 07-08 timeframe or the 2000 to 2002 timeframe. But we're clearly rolling over, suggesting that employment is starting to change. I'm sure if you're on Twitter, you've seen this University of Michigan chart, but what it shows is when this is below this magical 70 level, typically you can see some stress on it, and you go back and look the 78 timeframe, the 1990 recession that we had, the 01 recession, and the 08. All of these are important. Now, this thing has been receding since COVID started. And just telling us even the burst into 2021 where we had the SPAC boom and all of that kind of stuff, this PPO momentum indicator is still plummeting. Again, this thing is breaking down really, really hard. And normally we would have some sort of help from the Fed. But again, the Fed is on the other side of the table here, trying to control inflation. There's lots of jobs available. So as long as there's lots of jobs available, it gives the Fed room to apply interest rate pressure to the market and kind of control this inflation. For people who are in the commodity world, we're starting to see the commodity markets as, will a change in interest rates help get more gasoline out there? Probably not. So those things are starting to make us worry a little bit more. I will say if I had one chart of the commodities that makes me a little more concerned, it's that the momentum indicators are starting to make lower highs on stuff that's everybody's very, very bullish on. I covered it off last week in a special newsletter to clients about how I thought the material sector was changing. For people who are members at Osprey Strategic, you can go in and look through the old ones and just see what's coming up. I think the bigger context that we need to be aware of is that we are in a changing environment, and we have the potential here to be going into a really big, longer-term recession, and we need to protect our capital in the stock market and get back in on a timely basis when it starts to rise up, and that's what the Schnell Strength Indexes are about. So anyway, with that, I'm going to leave it. Thanks for taking the time to join me here on Market Buzz. Market Buzz airs at 10:30 a.m. Eastern Time on Wednesdays, or you can watch it on StockCharts YouTube channel. Again, thanks for joining me. Have a great week and good luck. Stay focused out there. Here to wrap it up is a P&F chart of the S&P 500. This was a big bull market. We're now in a bear market. We need to be aware of that. Target of 332 on the SPY. Pretty ugly. Thanks, everybody. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.